Hi everyone, this is Rick MacDermid here with Senior Solutions Group, and thank you for checking out this video. And I'm going to talk to you about safe options for retirement for your money. And we often talk with people on a day-to-day basis who, when they were working, they had the wind at their sails. Thus the picture of the sailboat. So when you're working in your 30s and 40s and 50s, you have a paycheck that comes in every 2 weeks or every month. And you also may have a 401k match. And if you're very, very lucky, you may even have a pension. Those days have come and gone for the most part with pensions. So if you want to think about a three-legged stool, now my grandfather, when he worked back in the 50s and 60s and 70s at Boeing, he was an engineer and he retired when he was in his mid-60s, and he had a pension. And with his pension, he also had Social Security income. And he also had personal savings. He was a farmer as well. They had a small family farm, and when he retired, he had a pension that supplemented his Social Security. These days, we don't see many pensions. A lot of the companies have done away with pensions, and the market was booming in the 80s and 90s, and people said, hey, let me invest my own money in 401k money, and you can match that money. So the company said, great, that's not our job anyway. Our job isn't to pay you a lifetime income. Our job is to pay you when you work here. So now we're left with Social Security and personal savings, or 401ks. And how many of you would agree that Social Security is kind of on shaky ground these days? For my clients, most of my clients that are in their 60s and 70s and 80s, Social Security is just fine. But for my kids and maybe my grandkids, they may have to make some changes. They may have to raise taxes or raise the Social Security age. When it first started, it was age 65. Now full retirement age is age 67. And I wouldn't be surprised if they change it to age 70. So now we have a two-legged stool, which is not as stable as a three-legged stool. So what do you do? Well, I'm going to tell you a story about two brothers, Steve and Bill. So imagine Steve and Bill both retire, and they each have $500,000 in their 401k or their IRA. And so Steve retires with $500,000, Bill retires with $500,000, and lo and behold, 10 years go by and they each deduct $30,000 a year from their retirement accounts. Each of them have their retirement accounts invested in the S&P 500. As an example, a good barometer. At the end of 10 years, guess what happens? Steve, even though he's taken out $30,000 a year, now looks at his statement and he has $874,000 in his account. You think Steve's happy? What if his wife said, hey Steve, can we take the grandkids to Disney? And Steve's like, oh, Disney, my goodness, all the lines and the heat and the crowds. Oh, okay, yeah, we can afford it. Sure, why not? What if she says, hey, that cruise we've been looking at, it's on sale now. Can we take it? Steve said, sure. Hey, you know what? Those friends we haven't seen for 20 years, they're going to be in town next month. Can we go to that restaurant with that fancy steak dinner and the wine? Sure we can. We can afford it. He is living the retirement of yes. How many of you like to be Steve? Raise your hand. Of course. Now let's look at his brother Bill. Bill looks at his statement and he's only left with $96,000. Well, that's a head scratcher. They both had $500,000. They both withdrew the same amount each year for a period of 10 years. What gives? They both had their money in the S&P 500. Well, Steve had the fortune of retiring in the year 2010, right before one of the biggest bull runs in American history. So you can see his account never went below $500,000. It kept growing and growing for most every year, even though he's withdrawing $30,000 a year to supplement his Social Security, ending up with $874,000 and change. While Bill, he unfortunately retired in the year 2000, where markets were flat. You can see the losses each year for the first few years. Then they rebounded a little bit, then they went flat again, and then they started to go up one year, then down again, then way down in 2008 when we had the housing crisis. So he was left with $96,000. Do you think we should all be like Steve or Bill? Well, none of them had a say in what the markets did. It just happened. So I don't know if you want to say both these guys are idiots. They're not idiots. They just happen to retire at different times in life. As a retiree, if you had a 90% chance that your retirement income would last those 10 years, that would be like being on an airplane and the pilot got on the intercom and said, hey folks, The weather's great here at LAX on our flight to Boston, and skies are going to be clear. We have a 90% chance of landing this plane. How many of you guys would stay on that plane? Well, none of you would, right? So what do we do? Well, if you're retired, you might want to consider the three different investment worlds. We have the world of safety and guarantees on the left-hand side, where you can put your money in the bank, give it to the government, buy government bonds, in other words, or fixed annuities with insurance companies, life insurance companies. Your principals are going to be guaranteed. You're never going to lose a dollar. Your interest is guaranteed. The term is guaranteed. There may be penalties for early withdrawal, and you may make up to 5%. You might make 0% if you put it in a savings account. Why doesn't everyone put all their money there? Well, it's obvious. 5%, that doesn't maybe keep up with inflation, especially with today's economy. Okay, well, Bill and Steve have all their money in the investment world, where you have risk along with potential growth. You've got mutual funds, you have stocks, real estate investment trust, insurance company, variable annuities. Your principal is not guaranteed. Your interest isn't guaranteed. There is a term, which is generally open-ended, so your money is very, very liquid in most cases, but you need a four-letter word to make this effective, and that four-letter word is time. How much time is needed? Well, as people get older, as they retire, they might say, I don't have as much time if we have another market collapse. And it's not a matter of if, it's a matter of when. So can you afford to lose 40% in your 401k or your IRA? Maybe if you're in your 30s or 40s or 50s, but what if you're in your 60s or 70s? How much time do you have left to make that back? You can also make 40%. So it's anywhere in between. Again, we get back to Steve and Bill's story. What if there's a third option? I call this third option the hybrid, and we have this option. This is where we work. We don't do the investment world. We are not licensed for those investments. We work with insurance products only. In the hybrid option, that is with a insurance company, a reputable life insurance company, which is a very safe vehicle, kind of like a bank, where you can invest your money and start with your principal being protected 100%, just like it would at the bank. You're linked to an external market over on the right side, but you're not in the market directly. Therefore, you don't incur any market risk. There are penalties for early withdrawal, but most of these companies allow you to take up to 10% a year with no fees. Now, you may, in a bad year, make 0, but in a good year, you can make 10, 15, maybe more % to grow your money in a safe environment. And you can also set up a lifetime income that you can never outlive. So this is an option for retirees. If you don't want all your money on the right side in the investment world, you can take a portion of it, maybe up to half of your money in the hybrid account, to where you can grow your money safely and sleep well at night. And you can still live the retirement of yes. So the retirement that is my grandfather's retirement. That really doesn't exist for most people anymore, where you have a pension. So if you want to set up a lifetime pension, the hybrid is the way to do it. So if you have any questions about this, feel free to reach out to us at Senior Solutions Group, and we will be happy to answer any questions. If you haven't done so already, please like this video and share this with a friend, and have a great rest of your day.